All right, welcome back to another episode of Exploring the Process. This is episode 9. We've got the wonderful at FX, aka my partner in crime, Chris. Welcome. Glad to be speaking with you on this beautiful Thursday morning. Hope all is well. Yeah, things are good.
Yeah, good, buddy. Yeah, thank you.
Awesome, man. Awesome. So this episode, the plan is really to go kind of back to basics, right? So kind of almost like take it from, Chris has been doing this about 3-4 years, right, bud?
Yeah.
Well, 3-4 years. I started 5 years. All right. So I started almost 2 years ago, probably close to this date, right? It was March of 2020. Again, just sort of some basic stuff that has certainly helped me in terms of like what not only my daily grind is, but then some of the weekend work that I do. I shared on Twitter, Chris, I think you saw, some of the notebook, right? And just writing down a lot of the world indices, 1 week, 1 month, 3 month, 6 month, year to date, and kind of why I kind of focus on those. And then obviously just kind of pulling in Chris's thoughts here as well in terms of like where obviously, he's certainly, he's done a hockey stick in terms of his analysis and the tools that he uses today, but certainly kind of maybe pulling in some of the books that he's read in the past and that kind of stuff that has helped him certainly getting out of the gate. Right. So we've all, if you haven't kind of listened to our journey or how we got started, that would be episode 1. I would probably encourage you to start there. And then about 2 weeks ago, maybe it was 3, we did an episode about price volume volatility, where we walked through a number of Chris's sheets that are public and are available, get updated daily, right, bud? Yeah, they get updated daily. And then I think even some of the Google numbers, they get refreshed anyway. So the point is, they're Google Sheets. They're out there for your consumption if you want to leverage them. I'd really encourage you to go watch that episode as well. And then today, I guess we're just going to go right back to kind of the crux and the basics. So Chris, I guess I'll just throw it to you first. When you started, and I know you already kind of had Real Vision background, so you weren't complete, noob, but what I guess was some of the biggest challenges, and I know from your seat and from many of our potential European or non-US listeners, a lot of the risk range stuff, and you mentioned this before, you really only leverage about 20% is applicable to your kind of general investment process. So I guess my question is how, because I know how you overcame it, but like how at the beginning, like how did that impact you, I guess, right? Or like, what did you try to do at the beginning to make those adjustments or to leverage like the tools that are at hand, right? In terms of risk range, early look, macro show, et cetera.
One of the big things, although I don't do it as much now, I don't have my notebook doesn't have a lot of numbers on it because all my spreadsheets have the numbers on it. So my notebooks have a lot more like little notes from whatever the macro show or the early look. But for sure, I did do all the numbers. What it forced me to do was, like anyone, depending on where, we've talked about this before, and I always ask it whenever we've had like guys that do follow Hedgeye. It's like, when did you join? Like, what quad were you in and where were you going? So a big part of that is like, I made all the mistakes right at the beginning of, we're transitioning from quad whatever to whatever. And 3, 4, or 5 of the assets have moved. And then because I didn't execute when I should have, you feel like, oh, well, whatever, XL, whatever, is also good in this quad, so that's not gone with the rest of them, so I'm going to buy this one.
So not realizing that like the signal strength wasn't there.
Exactly. Yeah. It's kind of that, I guess it's that kind of value mindset that you would probably have. A big part, I guess another big part was, yes, I did follow, like I was watching Real Vision, and I guess in a way it helped, as do listening to a lot of podcasts and stuff. But I now find I have to listen to them less because it just doesn't matter. It doesn't. It's just, I get, in a way, it's like so it's like today there was a question. We're in a group on Twitter, and someone just asked, because I do follow FX, of course.
Yeah.
You know, someone said like, oh, what impact will the ECB meeting have on the euro? And my reply was, I didn't even know there was an ECB meeting today. Like, yeah. Just writing the number, like the numbers tell you what you need to know. I know it feels painful. I know it feels weird, but buying the things that are going up, they tend to go up more. Everyone always thinks you have to buy the thing that's going down.
Yeah.
It's like, oh, but this is even better now because it's gone down 10%. And it's like, yeah, but you're not considering why it's going down 10%.
Yeah, exactly. Yeah, I mean, I tweeted that the other day, right? I mean, in terms of, and I'm dead serious, and I mean this from like the bottom of my heart. Like, 2 years ago, I got introduced to Hedgeye, and basically Keith and the team introduced me to incorporating math into my process, like in terms of like investing. And my prior, basically at that point, 15-year career had been like looking at valuation, EV, what is the, what are the EV to EBITDA multiples, like, and I haven't looked at a multiple. I couldn't even tell you I couldn't even pick a number out of the sky in terms of telling you where Amazon trades today or what Tesla's like. Yeah, like I know their market cap. That's about, I don't even know if I know their market cap, to be honest. I don't even, Tesla's, I'm gonna get. I think Tesla's maybe around 800 billion, but like I don't know that. I have no clue because I don't care.
Billion.
Yeah, exactly. $1 trillion. Yeah. But yeah, I just don't care, right? It just does not impact me anymore. And the math component and just the numbers has been a complete game changer in terms of like just filtering out the noise. And that's one of the big things. And sometimes I'll go on Twitter to interact with people or to like share like during the day, right? Like I'll go on to interact with people, or somebody will kind of like DM me and I'll get a notification. But in terms of like scrolling through Twitter and like trying to and looking at like what folks are saying or like in the moment, the emotions, I rarely do that anymore. Now, when it's hard to separate the now versus the then. And the then, that was a big piece of like, especially, basically looking at anything that Keith was, tweeting and some of the details that he was sending out, because those can be quite helpful because, he's gotten a lot better today in terms of like the RTAs and, kind of explaining more about why he's doing something. But when I joined in 2020, we were in basically a deep quad 4, one that they had called for since 2008. So, since late 2008. So they had basically been riding bonds, gold, dollar, like forever. Right. And so, I was capturing like the tail end. So to your point about like, when do you enter? I diligently, and I'll say, I think this was a good move. And anybody that is new to the Hedgeye process, I would recommend you take at least a month to just absorb it all. Right? Like figure out what works for you, like I just write down my numbers to this day, right? Here's all the risk ranges. Mm-hmm. Now there are no notes under here because we're doing this call at 9:00 and we haven't had time to watch the macro show, but notes will be filled in as I watch the macro show or, that and that kind of thing. But long story short is what I did was I think it was like late March or April. I spent almost 2 full months. I don't think I made my first investment or my first like trade from a Hedgeye process until May. And I think I bought gold. But I bought too big, too early. Mm-hmm. And then it kept going away from me. So then I got bigger. And then all of a sudden I was at basically, Keith's 12%. I was like, fuck, this thing keeps going lower. um and like, he hit the RTA, right? He hit the RTA. I bought it, and it kept going lower. And it was kind of at that time frame in May, if you recall, in 2020, where things started to shift, right? It started to shift from that quad 4 to like a quad 3 type environment.
Yeah.
And gold obviously doesn't operate as well in a quad 3 environment.
Right. I think it.
Or sorry, no,
that was probably quad 2. Quad 2.
Sorry, quad. Yeah, sorry.
Yeah.
It does operate well. Quad 3. I apologize. Yes. So that it was quad 4 to quad 2, and then it shifted to basically a quad 3, right? So, which saved me. So that the quad 3 saved my ass, because then gold, like I held it and I didn't, and I was like diligent, and I, but long story short is you're exactly right in terms of, if like we've called a quad 4 today, like if you're entering in the last 3 months, we've called a quad 4 basically since December. I mean, again, like round numbers sake, the Q1 call, the Q1 like macro deck was like, it's quad 4, right? So, or like prepare for quad 4. So we're almost a full quarter into this quad 4 environment, and there are many Hedgeye subscribers, Jedis, whatever, I mean, who've been riding the gold, the dollar, bonds have been so whatever, but basically, it's very impactful in terms of like when you enter. I think the other thing though is having patience is critical, right? So like this is a whole new process, and it's very intense. It's very intense. And like, if you're not, if you can't, to me, like if you're, again, it doesn't have to be that complicated in my humble opinion, but I think you have to have a repeatable steps in your day as to whatever fits into your schedule, if that makes sense. At least sure. That's what I've found. And I think if you look at guys like Gavin or Caffeine Addict on Twitter, even Trend Wizzo, who we've had on, Fracted Cat, I mean, the list goes on and on, right? I mean, Jimmy, you, like, I mean, Leslie, I mean, the list literally is bad. Like basically all the Jedi, like Hedgeye Jedis that I can almost guarantee that they have some form of a process in terms of like, what do they attack first? Like for me, it's I get up and I review like what's happened overnight, right? So like what's happened in Asia, what's happening in Europe, because typically, Europe's already open. What are kind of the futures doing, but I don't really pay that much attention because I find that noise, to perfectly honest. I'd rather look at like what the game gives me at like 9:30. And then, I do that assessment and I run through. From there, I'll go to Twitter, typically around 7, and I'll look at Keith's timeline. And I'll be like, okay, did a lot of the stuff that I was looking at that he's calling out, did I miss something? Or like, did I, et cetera, et cetera. From there, the risk ranges don't really come out anyway, but from there, basically there's a book that I read to my kids, or that I used to read to my kids. It was called like, there's 3 things I'll always do: love you, hug you, read to you. I don't know if you're familiar with that book. It's a great book. But yeah, it's 3 things I always do. And there's pretty much 3 things I always do every day and every morning. It's read the early look, write down the risk ranges, and watch the macro show. As you know, and I think I've communicated, I have a full-time day job, right? So there's many days I even have a 9 a.m. meeting, so I can't watch it live, but I'll certainly either catch it later, over lunch, or at night I'll go in and I'll kind of rewatch it, that kind of thing. So that's typically, I mean, again, in terms of like the 3 things I think are the most important to me, to my process, it would be those 3 things. It's like, capturing the early look, or like reading the early look, absolutely writing down the risk ranges, taking notes, evaluating, where are those ranges today versus yesterday? Is anything putting in a high or low, low or high, et cetera, et cetera. And then the macro show just gives you a lot of like poignant info, especially if you're listening. I mean, Chris, I don't know about you, but it often takes me 45 to 50 minutes to watch the macro show, because I'll pause and I'll write notes and rewind, re-listen, take more notes, or make sure I'm capturing the message that he's trying to say. and again, I mean, coach calls it diligent study, and I guess he's right. It's just, I find there's a lot of info there that, I mean, basically for me, my aspiration, I guess, is to run money professionally, right? I mean, I would love to do this full time professionally, either through a fund or, for high net worth, whatever it might be. I don't really know what it's going to look like, but that's kind of an aspiration of mine, Chris. And basically having Keith McCullough, an ex hedge fund manager who was quite successful for 10, 15 years of his career, and all those analysts on his team who also worked by side. I mean, it's basically like it's like, getting access to, it's just like, it's getting access to like an inner circle that's not available in many, really anywhere, which is why it's really cool. And that's why I really loved it right out of the gate, was because it was this like institutional product that was being made available for the retail investor.
Yeah, for sure. I mean, there's always going to be people that don't want that. People just want, like, I paid $1,000 for my Black Friday all access pass. I just want you to tell me what to buy and when to buy it.
Yeah.
And there is that. But like there's more than that. You're literally getting like you're getting a finance degree without all the bullshit.
It's the most, if you're willing to soak it in and take, and again, there's noise all over the place, right? I mean, there's noise again, but if you're willing to soak it in and absorb what is being basically sent your way through like a fucking fire hose, because there's so much information and data, and there's so much like content, and you and I, we're basically piling on top of that content. But hopefully we're doing so in kind of an educational way, and one that is helpful, So I mean, that's certainly our goal, right, Chris, is to do that. But basically you're absolutely right. I mean, so basically, I mean, the macro theme, like the macro, whether it's the mid-quarter or the quarterly updates. I mean, X2, who right? He joked to me one time, the first one he ever sat on, he was like, this was like getting my PhD in like 45 minutes. Like, this was insane. He was just like, that was the most intense brain exercise I've ever accomplished. And this guy is a seasoned vet running like millions and millions of dollars for a family office, right? Like, I mean, this guy is no joke. I mean, he worked on Wall Street. Like, I mean, this is a seasoned vet, and he's telling me, holy shit, like that was like a PhD in one sitting. And he's right, it is. So yeah, I mean, I guess long story short, after all that, whatever, the last 15 minutes, the point is you got to put in the work. And if you don't put in the work, and figure out what works for you, right? Like, I mean, I've got, you've got two kids under basically 10. I've got a soon to be 5-year-old and a 3-year-old. Life can get hectic, right? Like my mornings, I mean, I had to postpone this call by like 10 minutes because I was trying to get my kids into the car, right? And help my wife get them to school. And it's like, things happen, and like, but you just gotta, but you try to make the time for what's important. And for me, this is important. But that'd be kind of my 2 cents, right now is take the time to like listen, absorb, figure out what's important to you in terms of like what works, but and then go from there.
I've said it a few times that like,
I love it. He's making a little appearance.
So I've said it a few times that for some people, maybe even the macro show isn't like, for some people, like the early look, because you can take the time to read it, and ETF Pro, if you don't have the time, like without suggesting that people pay for that, but what I'm saying is, it's for some people, having like 4 or 5 daily products might not be the best thing for them.
Yeah, no,
and it
I
can
think you're right.
completely overwhelm them to the
Correct. I
point
think you're
where
spot on.
either they completely screw it up, or they just think this isn't for me, or and they miss what it can provide. Like taking a step back and maybe just having like the ETF Pro that's only updated once a week, and um
Investing ideas is
investment
once a
ideas.
week.
Yeah,
Investing ideas. Yeah, no, I mean, Chris, I think that's a really good point, right? For those that are listening and might not have all the tools, right? So, Chris has sort of the um, mid-tier kind of like, I think it's called like the elite pass, or what, I forget what it's called, but basically it encompasses, you've got macro show, early look, risk ranges, investing pro, the call, right?
yeah. No, ETF Pro. Yeah,
ETF pro and the call, I think, right?
I haven't got the call now.
Oh, you don't have the call. Okay. Um, so Hedgeye was kind enough to give me the macro pro. So I now have like everything. So everything, which has been phenomenal. But prior to that, I had the call and all the ones that you like, early look,
Yeah.
ETF pro, investing ideas, risk ranges, the macro show, kind of like that top right before the macro pro. But to your point, I mean, if you don't have the time and you really just are looking for guidance and like pivots, whether it's for your 401k or general retirement accounts, right? And you're just looking for like the big picture, like allocations to like take advantage of the full investing cycle, as Coach and Keith would say, then less is more, and filter out the noise. Like, don't read the journal, like don't read the Wall Street Journal, like don't put on CNBC, like it's fucking garbage, and just like it's so full of noise, and just like literally like harness in on the Twitter that is important to you, if you're even on Twitter, like go into the arena if you're interested in like kind of reading other things. Like, again, it's like, I'm not like, have other avenues, right? I mean, to your point, you've got podcasts, there's some great podcasts out there, including this one. But there's, there's great content out there that's better than the mainstream media, and like just kind of harness in on those, because I think if you can be patient selective, to your point, like if you're looking at ETF Pro, right, and Keith has gotten a lot better in recent months of kind of updating it more frequently, and not just waiting till the end of the month to do it. He's been doing kind of like some mid-month updates. I think that's been huge, and probably, again, that's like for bang for your buck in terms of just like overall market assessment of like where Coach has his core portfolio. I mean, that's like a no-brainer, is the ETF Pro, right? And you get the monthly basically review, and it goes through all that content that basically we're catching every day. And then investing ideas, I love reading there's the Saturday morning recaps from the analysts. But anyway, but yeah, no, I mean, I think that's a really good point, right? Like, figure out what works for you. Like, if you subscribe to like all of it or most of it, and it's too much, then like just peel it back. Just because you have it there at your disposal doesn't mean you have to use it every day, right? If there's something that's going on and you want to review the macro show, like do it. If it's not your jam, then like don't listen, or if you don't have time for it, like don't worry about it. Like, it's not the end of the world. Yeah. So I think that's a good point. And then, do you have anything else? I was going to kind of maybe go into some like tactical things in terms of like websites I use, stuff like that, just from a daily perspective, especially that I leverage out of the beginning, if that's okay.
Yeah, go for it. Yeah.
All right. So I'm going to share my screen.
Mm-hmm.
All right. So again, this is like pretty basic stuff, but this is certainly what I leveraged definitely out of the beginning, right? In terms of when I first started out. You can see actually up here, I still have the early look from this morning, right? Risk ranges. I wasn't joking around. During the day, during the trading day, I'll also have a tab for our RTA live. So basically, if I get a ping on the app on my phone, I can go in, take a look, read it. I might not take action straight from it, or like follow Keith into every trade, but at least I basically have it up just to have it up. Trading View.
That's the thing. Have you got an iPhone?
I do.
So there's a few people, like I say it all the time on the arena, but you've RTAs, there's an iOS app.
Yeah.
For RTA, and they come through much faster than they come through on emails. I know a few, definitely in quad 2, people complaining that the things had moved like 50% by the time. Yeah. But
Can you
also
guys-
as well, if
can you
you've
see
got a
that?
new, if you've
Yeah.
got a new Mac with whatever their new processor, their M1 processor, you can use iOS apps on your computer as well.
Oh, cool. I didn't know that. Okay.
So I can have that iPhone app open on my computer.
Sick. Okay. Yeah.
Just
No,
if people
typically,
want to.
yeah, typically I'll get pinged. It'll, because I have the notifications on, right? So it'll ding for me. And then I'll go and refresh or hit like the alerts button on the website. Sometimes I'll actually, because so many people are doing it, I'll actually pull it up on the app because it's like it's faster. And I'll, excuse me, I'll read it there. But in terms of like core product, in terms of just core things, right, that I found helpful, trading views is obviously one of them. I actually don't subscribe to them. So this is just like they're free. I just created a login for those that are watching, and really, I mean, I use their markets page as like just a core page for synopsis reasons.
Mhm.
You know, at the beginning, I definitely leveraged, and we had Fracticat on. There are basically, I think they fall under screeners. I forget what it is. Anyway, you can basically also find like basically his Bollinger bands, and have them tacked on to. I know you use TradingView, but long story short, I did use those like Fracticats. I don't use them as much anymore, to be perfectly frank with you. But they're still great tools, especially those that are kind of just trying to assess, what the, kind of what the Bollinger Bands look like. It's not Bollinger Bands, it's the bridge bands, excuse me, what the bridge bands look like, stuff like that. That can be very helpful for some assets. But in general, I mean, I use this main page because it's got all of like core indices that I care about. So if you kind of think about the risk ranges, it's got the S&P, it's got the DAX, it gives me the FTSE, the Nikkei, the Hang Seng. If I wanted to look at, Shanghai Composite, this is kind of where I come in and look at other more indices, stuff like that, right? I'll come in, but basically, again, this just gives me a general idea. Okay, what's the DAX doing? It's one of the biggest, most important ones in Europe. How does that fit into the risk range, right? So the risk range is 12,422 on the low end, 13,916 on the top end. It's off 3%. But it's kind of basically still near the top end of the range, right? So we're kind of top to middle. So, again, just stuff that I care about. Same thing with like futures, aka commodities. This is where I get a lot of my kind of just quick look on crude, natty gas, flipping over to metals. I've got silver, gold, you got ag right here, soybean, wheat, corn, sugar. Again, just like really quick right from the screen. Again, like I've got a day job, right? So like, I'm not, I sometimes have 2, 3, 4, 5 meetings a day, right? Demos, it's like, so again, so if I'm in between a meeting or I've got a half an hour, I can pop into TradingView and kind of take a look at my risk ranges and be like, oh, interesting. Like crude's at 112, or let's just say hypothetically it was at like 104, right? Which is the low end of the range. You're like, oh shit, like I should probably go buy some oil, right? So again, I can kind of come look in here. Same thing with currencies. These things all drive a lot of the core components of like trying to take action. So euros, JPY, currency indices is where I'll get like my dollar. And then as I just scroll down, this is, again, I don't even know where these come from, but it's really bonds is the other component here, which is on the, so this will also be a big one. I'll keep track of that. And then obviously crypto, I really just care about Bitcoin for general kind of risk on, risk off components, right? So again, this is really one of my core screens. I have it up all the time. And you go deep, you use their charts and stuff, right? Or not as much?
I do, but I have I have my own.
You have your own like code or whatever, right?
I'll use a chart after something's popped out on my spreadsheet. Yeah.
Right. Okay. Yeah. That makes sense. One of the cool things too, and again, Trend Wizzo actually introduced me to Tradestation. I haven't really started leveraging them that much, but they're a broker dealer here in the US, Chris, and it's actually kind of neat because they actually have some trading panels in here. So this is Tradestation here. So you can actually connect your broker from in here and put on like stop losses and basically leverage the trading view screens and stuff to execute actions at Tradestation. So for those that are unfamiliar, I haven't really converted over. Primarily Charles Schwab is where most of my assets are. I do have a Fidelity account as well. But basically, this Tradestation is really interesting. I'm going to start to migrate, especially my like taxable account over to Tradestation just to kind of leverage it more. Because Tradestation also gives you access to like futures and crypto and stuff like that, which Schwab doesn't right now. So I want to have a bit more of a broader scope of options in my toolbox. But this one I thought was pretty neat how it does integrate with TradingView. So I will likely start using TradingView a bit more frequently in terms of like just charts and stuff, because it'll be a bit more synced to my brokerage account. But anyway, just a little bit of a tidbit there. Again, I do not work for TradeStation nor TradingView, and none of this is investment advice. None of this is investment advice. The other huge one that I leverage is Koifin. So this one I think is one of the most underrated applications out there, especially their market dashboards. This is what drives, again, folks saw the notebook I shared over the weekend in terms of, where am I getting my information? It's pretty much these dashboards, and I have them set up where it just gives me a 1 day, 1 week, month, et cetera, right? So like all the important timeframes for me that I care about. So in here on the weekend, especially, is when I'll come in during the day. Typically I'll have because I care about the US, you might not care that much, but like, I typically have the US sector up as kind of like my default one. And then I'll pop into other components, right? So, there's commodities down here. So it gives me all of my different kind of commodities, especially during like quad 3 and that kind of thing. I was in here a lot. Obviously, fixed income factors gives you an opportunity to review kind of what's happening in terms of duration, US corporate credit, et cetera, et cetera. The other thing as well, they have a great factor analysis tool too. Now, again, this is basically the ETF divided by the SPY. So it's not direct returns, but it is nice in terms of like, okay, where's outperformance happening?
Relative performance,
relative performance. So again, this gives you kind of like factor exposure details. So I would definitely highly recommend coming in here. And again, these are all just free. These market dashboards did not look like this, but all you have to do is come in and choose columns up here, and they give you a bunch of different details in terms of like change, quarter to date, month to date, all this kind of stuff. And you just drag and drop and whatever's important to you. So I kind of just break it down to what I think is important. And again, Chris, you definitely do a lot of detail on kind of like percentage changes, right? But I'll lean on you in a hot minute. But basically for me, the way that I come in here, certainly on a weekend, is I'll look at the 1 week, right? So I'll sort by one week returns, positive to negative. And that gives me an idea as to what obviously had momentum that week, right? Week over week. So in this case, right now on a Thursday morning, you've got energy up, Utes are up, and then pretty much everything else is still very much, staples have been absolutely getting kind of one of the weakest ones as of this morning at 10 a.m. But point is like the week gives me a picture as to kind of what's happening now. The month gives me an idea. It's basically trade from like a Keith's perspective is kind of how, I know Gavin's talked about it that way. It's an easy one to think about from a trade perspective. Like if you've lost 1 month price momentum, you've likely lost trade. Now, again, it's not going to be exact trade line. It's a much more complex, much more, calculus driven detail, but that's kind of how I think about the 1 month is kind of trade, 3 month is trend. And then 6 month gives me more of like kind of a longer term picture as to, okay, does it have like, is this sort of almost like a full cycle investing type thing, right? So like, has this had basically 2 quarters, call it, of like momentum or 2 quarters of positive gains? If so, this is something that I want to make sure that I am probably being long of, or if it's, or, in this case, like real estate, we're teetering on trade, right? So, or like 1 month price momentum. Yeah. It's not anywhere near like what trend, but it's kind of, there's right here, real estate looks interesting. It'll be interesting to see how this finishes the week to see if this gets any closer to kind of to me regaining 6 months, because if that does, then it kind of moves up my list a little bit. And again, if you kind of think about the story or the narrative, which I, don't always, you and I certainly don't really give two shits about, but it kind of makes sense. Cause like, there's some, REITs typically kind of go lockstep with fixed income, right? With bonds, and bonds certainly appear to be kind of putting in some lower highs. So real estate regaining momentum kind of makes sense. But long story short, this is how I look at it. And then year to date is really making sure that I'm capturing something that is providing alpha, or like generating alpha this year, right? Again, like I don't have anybody that, other than my wife, that in terms of like, okay, how are we doing? This is purely from a competitive standpoint, right? It is that I want to try to be the best. And so if I want to be the best, then I need to be aligned with, to your comment a few minutes ago, things that are going up typically continue to go up. So if there is an exposure that I don't have on that year to date is positive, or is year to date one of the best winners, I need to figure out how I can, whether or not that deserves my asset allocation, or, how I can get back into it at like the low end of the range, right? Or like when the time makes sense. So that's kind of how I think about those timeframes.
So in saying that, like in the past, so I came into this as a trend follower. So that would be a 1 month breakout, right?
Yeah.
So in the past, I would have bought that breakout. Whereas now, what I look for is the trigger of making a new 1 month high. But what you actually want is a higher low. So instead of buying the breakout, you wait to see basically what's price volume volatility. So you wait to see how the price makes the levels that it makes.
Sure.
So instead of buying the breakout, you wait for it to pull back, and then you're like, what volume was it doing? Like, did volume spike when it went down? So people were capitulating in the price. Like, does it make a lower high? A higher low, sorry. Did it make a higher low? Rather than, it's made a new 1 month high, I have to buy it.
Right.
Because that coincides with, as you go further down the line, that coincides with the risk range will probably transition at that point from bearish to neutral.
Neutral, yep.
When it makes a new 1 month high. So that'll be the first one. And then at some point, the volatility will come down again.
Yep.
It will be at the low end of the range, and then it will transition to bullish.
Yeah, absolutely. And I think the same thing can be said for any of these longer dated ones, like year to dates, right? Like if you're, for instance, like energy being up 38%, right? Like I have not, and I've been very public about this. I've owned, I got out of my energy in December, right? I've owned absolutely nothing. I've owned, I don't think any commodity, or maybe I've owned copper for a hot minute, or natty gas for like a hot minute, but those are basically trades. Mm-hmm. And so I've not really had the commodities on. Now, from an inflation standpoint, I've had other components on, right, to capture that, like gold or dollar. Even like agriculture has been one that I've gotten into recently. I think it's like basically agribusiness. Anyway, long story short is like the year to date, though, I think is a really good point too, because if I start seeing that this either number starts to decrease, so that typically would mean that it's making a higher, basically a lower high, right? And so then it's like, okay, like, is it also making a lower low, or is it just like, or is the volatility just basically shrinking and it's just doing a bit more of a consolidation pattern? I think there's just a huge difference there, and you learn that over time, right? Like, we're trying to take it back to like what we didn't know basically 2 and 5 years ago, and at that point, I wasn't even doing this weekly work at that beginning. To be perfectly honest, it wasn't until like Caffeine Addict really. And I leaned on him a lot. He's been an awesome kind of like, mentor and friend, from the beginning. He was kind enough to, really just kind of teach me a lot, to be honest. And so, but he basically just started sharing, like, I do this during the weekend. Like, this is what again, he wasn't as specific as what I'm showing right here, but I just picked up on the nuances, right? In terms of like, what was he accomplishing? And then over time you learn kind of what bits of information, what starts to stand out, because you start doing it over and over again. I mean, I've now been doing this basically for like, over 18 months at this point, in terms of this same process and the same workflow, taking up like 5 pages in the notebook.
1 second.
Yeah, no worries. So yes, it's
Craziness is about to come home.
Oh, sorry. Yeah, I know your kids just got home. So yeah, anyway, so this is another component in terms of like just the weekly assessment. I think a couple other things too, in terms of stock screener. Trend Wizzo actually introduced me to both this FinViz. Again, this is just an easy place to kind of look at general screens for information, whether it's I use this for high interest stocks, right? Like a couple of months ago in January or February, when, quad 4 is really starting to pick up, like high interest stocks, like, or the opposite, right? Low interest stocks really, right? That we just didn't like. So in say consumer discretionary and low interest, like low interest, low short interest. So, I'm not as, basically I shouldn't be as concerned, or there's not a variability there. Like basically, just a massive cover happening and I'm getting fucked. So this has been a great tool that he introduced me to. I did not have this one on my radar until the last couple of months. And then same thing with the Forex Factory here. This is basically more of like a calendar in terms of just important dates. This is something, again, Chris, I know you're joking, or like, it's funny because I don't necessarily put a lot of weight onto these, but I do like, just from my analytical side and my equity research side of the, how I started this whole journey back like 15 years ago, or almost like 18 years ago now. I do kind of, these to me, they still are kind of, important dates and important things to kind of at least know are happening. And yeah, so this is something, again, I like this one in particular because you can filter it down. So if you are European or what have you, right, you could pull in UK or Euro, right, just depending on what you want to do. I can apply these filters. And now I've got dates for multiple things across the board, right? Or if I wanted to be, more inclusive and do JPY and like Aussie, whatever, right? Again, it's just whatever makes sense to you. Typically, I kind of look at just the USD ones, and then because it's just kind of filters out some of the noise, because I honestly don't really care what your ECB is doing or the Japanese bank. But yeah, so this is another good one here that I like. And then lastly, go ahead.
Like in terms of because of it, I know we're talking about the early stuff, but it's like, so as I've moved forward, the more back testing that I do, that's kind of the way I think about it. I'm not saying it's not important, because price obviously moves on these things. But if I'm looking at a 30-year back test, I don't have marked every time there was a Fed meeting or a whatever. The price moving on any of their meetings is captured in the back test.
Yep.
So when I look at like daily moves, like what's the average daily move of the S&P 500 for the last year? Like it'll all be captured, and that's these meetings. Like, so obviously, saying this morning, I didn't know that there was an ECB meeting this morning. Okay, but the price will be captured. The price will just be the price, right?
Yeah.
Because in a way, it's like what are you going to do with the information?
Well,
or like again, for me, all it means is it just means that there's a day where lots of people will be paying attention to one data point, and it might make them change what they do, or it might not, or it might make them, to use a terrible analogy, like double down on what they think. Like, oh, see, inflation is going to 45%.
Yes.
Like I know I'm joking, but I mean,
so I'll say, so the difference from when I started or what I used to, so again, these used to be events that I as a macro tourist, I cared about, right? Like these are things that were like that talking to clients mattered because they would be thinking about them. It would be potentially impacting today's current price, right? But what I've learned from Hedgeye is that the biggest, most important thing is to basically front run. Keith always says like front run the Fed, right? Or front run the tourists, front run just the majority of investors. And he does a phenomenal job with that in terms of getting us in the like pivoting in the right direction. Now, every asset might not be captured, but like in terms of like, perfectly, but in general, in terms of like the general pivot, I think I haven't experienced anything like it.
Yeah.
So now to answer your question, or like the way that I now think about it, is it becomes a data point. It's just a data point that fills in the chart that I get from Hedgeye in terms of like the 28 factor model that they, the nowcast that he has. So it becomes a data point. I don't put it in because I pay them to do that for me. Right. Like I don't, but I look at it and I can immediately see, okay, is this another like basically green data point or is it a red data point? And then they'll update it for me the next day and I'll know exactly what it is, but I can take an immediate look this morning at 8:30 and be like, okay, inflation, that was, and I don't know the number because I haven't looked yet, but like, let's just say it was higher, right? So like that's going to turn green, which means that could push, the deeper the quad 4 into deeper mode because you've got higher inflation that's going to suppress basically growth even further, right? So again, these are all things that I've learned over the course of the last 2 years. At the beginning, I would have been like, oh shit, like not necessarily chasing because chasing has never been in my bones. And so like you're a momentum guy. I've never. So if something moved on me, I just accepted the fact that I missed it. So I definitely am the opposite. And you teased me the other day because I wanted you to send me something on China, and you're like, you fucking proctologist over there, McGrory? Like, what's going on? and it's true. I definitely like capturing bottoms, or at least trying to, but. But I've also learned from you and many others that, and Gavin too. I mean, I think he does this really well in terms of like riding winners, right? And that is a really hard concept because you hit this nail on the head. Like if we go back to the beginning of this conversation about like people are taught to invest in like cheaper stocks or like stuff with like cheaper valuation or better valuation in anticipation that it's going to increase over time and that kind of stuff, right? Or like it's going to get better versus the rate of change.
Exactly.
Yeah, go ahead. Yeah.
Perfect example of that is I don't want to rag on Real Vision, but like uranium, right? People have been going on Real Vision since 2015 talking about uranium.
Yeah.
And why now? Whenever like 2015, 2016, 2017, was the best time to be buying uranium. And then everyone all over Twitter, they were getting get all these guys back on, and hand high-fiving, woo, uranium, 2021. And it's like, but you've been sat with that money for 5 years. Or
exactly.
You haven't. You've told everyone to buy it, and then you got out at some point, and now you're like, high fives.
Exactly.
It's like, no, that's not how it actually happened. It's like, how many people actually stayed in the trade that you've been talking about for 5 years, right? How many people were like, oh, fuck this, I need to get out? How many people, as it was going up, are not actually just getting to a point, right? Well, I bought into random numbers. I bought into URA at 25. So as soon as it got back to 25, after them being in like a 40 or 50% drawdown, they're like, thank God, I got my money back.
Well,
how many people actually rode it?
Yeah, exactly.
Because there was a hell of a lot of people like high-fiving and stuff.
Yeah. No, you're spot on, right? And I think it's certainly kind of how I feel right now with some of my, weed stocks, right? It's like, holy shit. Yeah. I mean, when I do get back to break even, it's going to be like, okay, well, am I going to sell it? Probably no, because like, that's not the right move. But like, also it's like, am I about to buy it down here? Also no, because like we're going into quad 4. Like it doesn't make any sense. Like the rate of change is slowing. And that's what like going like basically to me. So again, like I've shifted in terms of like basically incorporating math, right? Like, and even the analysts, I think it's like from Hedgeye, I've learned a shit ton from them too, from like from a fundamental analysis standpoint, the amount of data that they review and the amount of like they talk about the pods, right? So just to steal, like, again, I'm not stealing it. We're very clear that this is all Hedgeye language, right? But it's like they talk about pods and quads, right? Quads for the macro, pods for the companies. And, as an ex research associate, I think in general, folks like look at rate of change, but they do so off of very nuanced or like just very relatively static / like opinionated like assumptions inside of a model, right? Like it's based off of more of assumptions versus like the data driving the fact. It's just like, okay, well, if you look at historically, they've had a 12% profit margin. Let's either keep it at that, or okay, they're the cost of goods have decreased, so their margins are going to increase. Let's model a 15% margins this year. This is what again, like I think McGough maybe wrote about this in the early look on Monday, I believe it was, about basically many analysts just follow guidance from companies, right? The guidance comes out and they give a range, and analysts will kind of stick it pin in the middle, or maybe they'll be a little cheeky and go to the low end of the range, or a little bit higher to the high end of the range. But many analysts have a hard time. And again, like there's other exterior factors, you've got bigger banks, all that kind of stuff in terms of, you got the banking arm, you got the lending arm, it's all a bunch of different like factors that go into this analysis. But point is, and what I'm trying to get at is the rate of change it's basically the golden rule. And I know you've incorporated that into your analysis, into what you do. That's why I think, when you say it's just about the numbers, that's for the most part, what you care about is the rate of change. And for anybody starting this journey, if you can just get that through your skull and understand that it's like the rate of change and it's the data and the numbers, and if you filter out the noise, you'll get up to speed so much faster.
I think in a way it's like obviously this is what I do. This is what pays the bills. Like I've been bitten by I'm bitten by the bug. So on a Saturday night, if Jen goes out with the girls, like I don't get the beers and whatever in and sit and watch the football. Like if she gets in at 2:00, I'll probably be sat here building a spreadsheet. That's how boring I am. But the thing is, and we had a conversation about it the other day, it's like, but like, I feel like trying to pull some new data in from somewhere, or like sitting for hours cleaning up data. Like, I love it. Like, this is my hobby. It's like my hobby and my job and everything all rolled into one.
Yeah.
But there's a part of it, like, if I know I'm biased because I do only look at the numbers, but although it's important, these are people's retirement accounts or, trading accounts or whatever. In a way, if you don't want it to be your job, wouldn't you want to just look at the numbers? Because then instead of spending time watching CNBC or Real Vision or all these other stuff, or reading, you could be going and doing stuff that you want to do.
Yeah, like playing golf or whatever it is, hanging out with your grandkids. So whatever, like literally whatever it is.
Instead of listening to all these opinions and whatever, you could actually go and do stuff that you want to do. Because, and it's harder now. I wanted to share all my spreadsheets, and I do share the ones that I do, but I use an external source now, so it's not as easy to share them because you need to pay for the data.
Yeah.
But that was kind of why I started posting the spreadsheets. It was like, well, I've already done it, so why does everyone else have to do it? And then if people use it, they can use it, and if it helps, it helps. But it's like,
and that's not, I mean, Chris, I love you dearly. It's like one of my favorite things about you is like you're so selfless, and you love this so much, and you've built the work, and not everybody is as gifted. Again, you joke around about your janky sheets, but many folks look at your sheets and they're like, holy moly, and their mind's blown because they're just not comfortable inside of Excel or inside of Google Sheets. And you're so selfless that you just share that information. And it's again, I mean, it's one of my absolute favorite things about you. And it really is. I mean, you're an absolute, I mean, you've got a heart of gold really at the end of the day. And it's brilliant. Because many folks would be like, well, fuck, I built this. I spent a lot of hours doing this. Why would I share this with people that I don't know? And it's just, you have the complete opposite mindset. And luckily I'm, whether it's my Catholic upbringing or whatever, but it's, it's like, I have a similar thing, right? I mean, it's just like, why not, if you love something, and how much I love not only investing, but certainly talking about Hedgeye and the improvements it's made on my life, both, in terms of the portfolio, but also just kind of just coming about it. And, just it's trickled into other things, right? It's trickled into my sales job. It's trickled into other components of life. And it's just brilliant, man. So it's a lot of fun, and I'm with you. I'm very similar in terms of I'm constantly thinking about portfolio allocation, how to improve my process, what's potentially going to happen today. What should I be preparing for next week? Like, I mean, if Jody's out, my wife, and even last night, I walked downstairs like 5 o'clock after I was kind of done the day of work, and she knew that Wednesdays this week was like typically a 4:30 notebook review session yesterday, and it was her birthday yesterday, and she was like, oh, like, I really wasn't expecting you down until like 6. I was like, well, that's very sweet, but pretty much there was a unanimous consensus inside of Hedgeye Nation that I needed to get the fuck off the computer and go hang out with you for your birthday. We did have a great, we went to Italian restaurant in town. We had a nice meal. The kids were awesome, but yeah, man, it's just like one of these things where luckily I think we both have very supportive partners, and they know how much we love this. But we're pushing, I think, an hour. I have one last watch list inside of my trading system that I want to share. Again, this is just like very basic stuff, but just one last thing, because I figured out how to hide my balance. So no one's going to judge me. So again, this is the Charles Schwab Street Smart Edge application. I download, or actually I leverage their like cloud version. So these are just my watch list, right? So I've created these inside of here. This is kind of the core one that I have up. It's just called Watch. It's got basically the top 7, or kind of like I forget. Liz Ann Salinger had a really fun name for the 7. The name in my head is Sexy 7, but that's not what she said last week. Like she called them, but I'm going to just keep calling them the Sexy 7. Yeah. And so again, if you kind of go down in terms of, we've got Netflix, gold volatility, Amazon, Microsoft, Compex, SPX, VIX, Russell, Vixen, and then this is like the comp, like or the basically the what is that? That's the 100, right? The NASDAQ 100. Yeah. So again, this is kind of just stuff that I have up. It gives me an idea, sort of like general market moves, what's transpiring. I've got, again, I kind of narrow it down because I don't really give a shit about market cap or any of that other nonsense. Like, really, I just care about, what was last price, because that's what I can then take to my risk range sheet, right? And review, okay, Amazon's at 29.33. It's at 3,052 at the top end of the range. So although it looks interesting, I'm probably, I'm just going to kind of wait on it. Right. So but then again, in terms of, we had a thing, our session the other day was price volume volatility, right? These watch lists are built because it's like price volume volatility, right? Like I don't have Excel sheets. I don't have fancy fucking shit that helps me, narrow it down. I kind of, again, like I've done this for a long time. So like I can kind of visually see it on the chart, on the graph. And then once I incorporate the price volume and then kind of take a look, okay, here's today's volume, average 1 month. Again, I have this up here too, in terms of like, what is happening in the last week. So that's percent 5-day change. 1 month is my trade. For some reason, Schwab doesn't have 3 months. So I can't really see trend, but I've got, 6 month, 1 year. And then again, over here, I've got sort of like average 6 months. So if volume is either really weak or really strong, I will kind of scroll over to the 6 month. But I do find when you do yours, do you typically look at 1 month average, or I think you also do 3 month, right? But typically it's 1 month, right?
Yeah. So when I use, because my breakdowns are 10, 20, and 60 days. So 10, 20, I use 1 month.
Okay, perfect.
So what I do is I take the 1 month average and then compare it to today. So it will say so if the average volume is 1 million and today it's 500,000, and obviously it's minus 50 against the 1 month average. So that's
Got
how
it.
you get, so you kind of get to see these waves where I've said before, like against the 1 month average, the volume will start to look higher because, like, let's say a big, huge chunk of volume that happened on either a down day or something like that is slowly moving out of the 1 month look
Yes.
back. The volume
Yeah.
will just naturally start to look higher
Yeah.
just because all of that's moving out.
Right. Exactly. And that's a visualization that we can probably do another session on and just kind of look at. I think you may have shared it already, but you've shared it with me in terms of like the boxes that you put on. I think it's really interesting. But in terms of like watch list, though, again, so I'll use this as just sort of like a general market view. And then if I'm noticing something, so if I'm seeing like SPX is down 42.39. So again, hypothetically, if we're in more of a, if we're in quad 2, whatever, and I was looking to try to go buy something, or conversely, if this was at the top end of the range right now, and it's not even close to that, I'd be like, all right, let's go hunt for some shorts, right? Or like, let's go look for some longs. So I'll kind of use this to guide me. But then I've built, or, again, I've created a bunch of watch list that I update. So again, I've got an RTA long one. Again, this is not synced for some reason because it's still at Thailand, which is probably a good thing because I'm not really sharing any details here, but basically I'll update this, right? So like when the RTA comes in, I'll put it on here. I'll look at this detail. And then if it's on there for like a day or two, obviously I'll come back, right? So I'll be like, okay, like what's happening RTAs? Like, where are they? Where's the percentage change? Where's, whatever, right? So like what's transpiring? Same thing with some shorts, right? So any shorts would be similar component. So basically this is just tracking my RTAs. Here is where, again, hopefully Hedgeye doesn't mind because this is some proprietary detail, but basically, again, I update these investing ideas long. So again, so the setup is something where I want to go act. I have these built out, these watch lists, so that I can quickly toggle between, okay, RTAs, investing ideas, which is like kind of longer term stuff out of Hedgeye. I've got, ETF Pro, longs and shorts, right? So here's like the details, right? So today, if I'm looking to get long or something, TLT is down. So maybe, again, I'd come in here, I pull up my ETF. So again, so from the other day, here's my risk ranges from both investing ideas and ETF Pro, right? So I flip to that page. I can come in, like TLT's loan to risk range is 135. So 134.26. That's probably a place because I'm at 300 bips. I'm going to want to go buy some. So as soon as we get off this chat, I'm going to go buy some fucking bonds. So anyway, the point is like basically I have these built out, right, to help guide me as I go through. I've got the shorts, etc. I have some built out for global markets, right? So this is basically all different global ETFs. Again, I can sort them however I wish. Lately, I've been sorting them from 1 month price momentum because I don't have I don't have risk ranges on all of these. And so I use 1 month as my guide from a trade perspective of like, what is going to, where should I be paying attention to things that are, regaining strength. So for instance, like Malaysia here, EWM just kind of regained 1 month price momentum, it's down on the week. So maybe I want to go take a look, review, go back into the PowerPoints that I get from Hedgeye, go see, okay, where's the quad set up? What's upcoming? Is this something that I want to be taking advantage of? Or is this a head fake? And do I want to short this at the shark line, right? To use some of Keith's language. And as I scroll through,
so would you, go ahead. So if in that example, would you go and look at FX after that?
Good question. That with ETFs, with the international ETFs, yes, because many of these get impacted, and you actually you definitely highlighted that more thoroughly for me, that this will often get impacted by the dollar moves, right? So I would then go and look at the Malaysian dollar. I think that's what, isn't it called the Malaysian dollar? Yeah. I'd look at basically, was this mainly impacted from the USD Malaysian dollar move, or was this more of a market move? That is correct. Yes. Correct. These these are a little bit trickier because there is a big FX component that plays a factor in them. And then again, just to keep scrolling along, I've got my commodities here, right? A whole commodities page. Again, I built this all out over time, ETFs. My 401k, I have to use Invesco ETFs. So this is my basically like, again, it's not all comprehensive of all of Invesco ETFs, but this is sort of my cheat sheet for, basically just capturing. Again, I'm just more limited on those. So I have to come in here and take and use these inside of my 401k. So and so again, I'll kind of sort as needed. I know what these all basically mean now because I've been doing that. I've worked for this company for 2 years, that kind of thing. So I know what all these tickers are. You probably don't, no, many of you probably don't know what this means, but anyway, I do. And then the other thing too, again, given my, and I haven't updated these actually, I don't think, but because sometimes I don't know, sometimes Schwab's weird where it doesn't capture the updates, but basically long story short, this is the Q1 2022 longs and shorts. So this is updated from like the basically market or like the market trend update or like the mid-market update or the quarterly update that you get, right? This is basically what's in there. And I know on the Macro Pro you get it, but I think you even got it on the mid-market update a couple weeks ago. This is what I'll grab these as basically, again, these are what I would consider more macro full investing cycle. Again, like many of these overlap, right? In terms of, the longs that you want to have from ETF Pro and stuff like that. But, you may have some other stuff in here, like EZA was one, that's obviously now on ETF Pro, but it hadn't been there up until the last week, right? So this was on my kind of like Q1 longs to keep a watch on and that kind of thing. So again, I have some of these other ones, and then best long-term ideas. This one really used to be more important. I kind of moved away from this one a bit. I just, but this basically was driven off of a lot of the Hedgeye names that were important from like the call and stuff like that. I've actually kind of more rotated. I created what, from Hedgeye on the prize, they basically gave all of the tickers at the time. So this one isn't, so this is a little dated, but I do basically try to keep it updated. But this was basically all the tickers that were available from the analysts from Hedgeye on the prize. That was like, that was incredible. Considering it was free, it basically gave you their entire universe of like stocks that they had research on. So that was like insane. So I skipped kind of the long-term one, and I had to create, there's so many, I think there's like 300 plus tickers here. So I had to create 2 sheets here. So this is kind of a lot of the Hedgeye names. So these 2, and then again, I've got China Pro. I'm not going to share that one because that one is very proprietary. And then with Macro Pro, I get Keith's top holdings most mornings from their note. So this gets updated. Again, this is going to be old, so I can share this, but this was basically, they're long. So again, this was like the longs that are in his current book today. And this was added when I got Macro Pro back in November. So, or actually they didn't start sharing that until maybe January, but long story short, it was, if you don't have Macro Pro, this one's very challenging to get. And that kind of thing. So yeah. So then again, back when I started, I had more like quad oriented things.
Yeah.
So I would have, so again, I started in quad 4 and we're now in quad 4, but I have one for quad 2, basically, like the core sheet, right? To your point in terms of like, okay, XLE is bad, right? So like, don't have it on here, but I've had to, I think I've had to add it back on, but these are just like, basically, again, that's how I started, was I used that slide deck, right? And I took those, whatever, I think there's like 15 tickers basically, right? And created quad 4 or whatever quad you're in, quad 4 longs, quad 4 shorts. Those were key tabs that I had at the beginning. I've changed things over time to like what is actually important to me. But I think this is really, it is having like a quad watch list of tickers that are impactful, right? Or that, that drive action inside of a quad. They can, I think that's a big one to build out, right? In terms of just knowing, okay, what is happening today, where should I be invested? What's at the lower end of the range, right? If you have that detail, stuff like that. So again, hopefully I kind of went through that quickly, but hopefully that was helpful for those out there. But that's kind of, again, this is very high level, important things that I use daily. And it's different than many of you guys, like including yourself, Chris. I know you use like Excel sheets, stuff like that. I'm definitely more of a watch list and notebook kind of guy. That doesn't mean that the Excel sheets aren't excellent. It's just, it just, different strokes for different folks.
So how long would you say it took you to get to where you are today? I mean, obviously it's taken you 2 years, but I mean, at what point did you start realizing like, I need to add these things in?
The watch list happened pretty quickly
Yeah.
because again, like I needed to get access to information quickly, right? In terms of, and my brain works with it segmented. So if I just had all those tickers on one watch list, my brain it wouldn't fry, but it just needed it to be compartmentalized. So I created those almost right out of the gate. Like I created the quad ones. Like again, I started in quad 4. So I created a quad 4 watch list. I created best long-term ideas watch list. I created all the products that I had. So investing ideas, ETF Pro, RTAs, those were all ones that I created originally. So, and then, so those were, yeah, I mean, I did that right out of the gate.
Yeah.
I think those are crucial in my humble opinion. Like if yeah, I just, again, I created those right out of the great gate. I think it's been very helpful because again, I can quickly toggle and then understand, okay, here's again, like going back to like coach's mantra of like buying red, selling green. Like it quickly allows me to look at like, okay, you know, in ETF Pro, here's what's down today. Are they just red or are they also like down and at the low end of the range? Because that also got
same time.
because that also allows me to rely less on RTAs and more on building my own book, right? And my own portfolio.
Yeah.
And using the tools that I pay for, right? And like the content that I receive from, you know, Keith and the team at Hedgeye and deploying that into my book of business, right? Into my portfolio. You know, I think the biggest things, so I created all that I created out of the gate. I think in terms of executing it more efficiently, that has taken me, I've been seeing the board really well in the last like 2 months. So basically call it 20 months. I mean, quad 2 is easy, right? I mean, quad 2, I mean, you can pretty much, the fucking monkey can at least return pretty decent numbers in quad 2, right? It's
especially in the U. I think I joked about the FTSE 100 only just made it to like where it was in January 2020, and now it's obviously shit the bed and down 20% in like 2 weeks.
Yeah.
But I mean, in quad 2, even the worst sector like XLU was still up like 15%.
Exactly.
So even if you backed the wrong horse, you were still up 15%.
Correct. So you're not, maybe you didn't like massively outperform the S&P, right? But like at the same time, I mean, my book was basically a shit ton of fucking small caps. So so again, like the S&P was my benchmark, the Russell was. And anyway, but long story short, yeah, I mean, it's, I think one of the hardest things to learn, in my humble opinion, was selling on green. Honestly, like it's easy. Again, like you're trained, or like I was, like buying a dip or buying on red. That to me is easy. Like the buying, and you and I have talked about this. Like I'm pretty damn good at the buying part. It's the selling, right? It's like when is this like a bounce to the lower high and I need to get the fuck out? Or is this like they're basically a first move up and I just need to trim 25 bips and then it goes again and I need to trim 50 bips? Or do I need to stay more patient and let it go to the top end of the range? I think that's the hard part, right? Because like the ranges, there's like the intermediate and then the trend, right? So like for ETF Pro and investing ideas, you get more of like the trend line, right? Is what we get on a weekly basis. So there's a big difference between like the trade and the trend, right? So like, ETF Pro, to your point a few minutes ago about like, if you're not touching your portfolio as much, then having the trend line is great because you can just set limit orders at the bottom, the low end of the range and put profit exits at the top end, right? Now I didn't really, people are going to fucking laugh or make fun of me, but like, I didn't really realize that I I was pissed because I didn't realize that I didn't think Schwab had like bracket orders that I could set inside of the system up until like basically 2 months ago or 3 months ago. And that's been a huge game changer because it's now just basically the system's just doing it for me. Like I'll put my profit exit either at, again, like depends on what it is. But I'll for the most part use the range to say, okay, like take profit at the low end here and then like basically reshort at the top end here. And I'll just kind of basically keep doing that. I wasn't deploying that until recently. It was probably another reason why I'm probably executing better in the last 2 months, because I'm not having to go in and like hit the button myself. But I think out of the beginning, it's challenging to, and we talked about this with Fracticat, right? It's like the timing and sizing on the beginning, like in terms of entry, is one of the most challenging things. And then the timing and sizing on the exit is one of the most challenging things, at least for me.
Do you know, and I think the getting away from CNBC and all the other stuff, like the onus is much more on you.
Yeah.
If you're just following, this sounds great, then if it goes wrong, you can just go, oh, it was their fault.
Yeah, like
whereas now, like you have to make a decision. Like Keith lays out what his, like 10% for a fixed income, 6% for an ETF, and whatever, 4% or 3% for a single stock name or whatever. That's shifting. That's just an easy way to share the information with people, but you have to make a decision. It's like, what are you comfortable with? And that's the hard part, is it's your decisions. You can copy that, but then you have to implement it. And this is kind of the bit, it's hard having to implement someone else's stuff that you have to do it yourself. And that's the hard bit. You have to figure out, like, whatever it is, or taking a swing on an RTA, if you look at it in that way, like some people might not be comfortable doing that. Other people might be like, well, you had an opportunity to go long it and short it in the space of the last 3 days. And it's like, that's your thing. You just have to, there's lots of stuff you could use, all completely parrot exactly what comes out of Hedgeye, or you can take what you need from it. And this is like, you have to make it your own, because at the end of the day, what it shows you is how you have to do your things. It opens your eyes up. At least it did for me. It opens your eyes up, and you have to make a decision. And going back to one of the like the episode we done with Trend, and that was like really intense, like the detail that he goes into. But just having, like, how many people, like if you're copying the position sizes that you've got from Keith, like how many people have written it down?
Yeah, I've written it down
like how many
20
people,
times.
Like how many people have written it down, and you have it in front of you, or you have it somewhere to say, right, am I exceeding these levels? You've got it in your head, but just as easy, you could be like, oh, well, this position's got to like 6.2%. So I'm just going to let it run for a bit.
There's something I haven't shared. And again, it's not proprietary, but it just has like account details in it. So I don't really want to share it. Basically, one of the other things I did do, Chris, was I did create, I could probably do, one second. I created an Excel sheet, basically. Long story short. I freaking love Excel, Chris. So people chirp at me for not using Excel. It's because my brain remembers things better if I write it down. So that's the only reason why I do. Not the only reason, but it's all right. So all right. I'll share this, and then let me see if I have one that I can probably do want to just take out details on it. Yeah. that'll work. All right. Okay. Can you see that all right?
Yeah.
All right. So this is, again, I got it broken down from, my family's got basically like 4 accounts. We've got my 401k, my IRA, which is another retirement account, my wife's IRA, and then our joint account, which is like our taxable, like cash account, or like, taxable account. So I created, again, this was something that I created at the beginning that I thought was going to be a key to my process. It is key now. And basically I just haven't spent the time to clean this up, but I only really use it to just double check my math on a position sizing standpoint. So typically what I just deleted was so if this, we'll just put it in for like $100,000. So let's just say your account's 100 grand. I basically have this flowing through to tell me, again, this is a quad 3 one, right? So I don't have like, I don't really care about these, but I originally created it because I mimicked or mirrored like what was a quad 3 typical exposure from that like PowerPoint page, right, Chris? Yep. Right. So it's like, here's the top 4, like back tested, equity sectors. Here's the factors, exposures, fixed incomes, crude, whatever. So basically, to your point about asset allocation, I also on every sheet, I kind of have this component, right? So FX is 12, fixed income's 10, equity 6, commodities, et cetera, et cetera, et cetera. So then, I've got longs and shorts here as well in terms of basically here. Well, sorry, I've got longs at 642. Those are basically the breakdown as to my equities. So a minimum is 2,000, again, this is simple math, right? So like a minimum is 2,000 basis points. But the other thing I have here is basically this component is if I'm buying incrementally, so again, everybody should know this, but if I'm buying, $250 is like 25 basis points of my overall capital, right? So again, 100 grand is like very easy. Obviously your portfolios aren't this basically static, right? But this is so I'll be like, okay, again, like most of I kind of already know this information from my account. So like, I know that like, whatever, 25 bips is X dollar amount, because again, I do this every bloody day, but this is important to your point, Chris, is like, write this down, right? Or like, make sure that this number is somewhere in your brain every day, so that if you want to know, like fixed income, I just joked about like basically buying TLT at the bottom, not joked, I'm actually going to do that. I'm going to go buy TLT today. And I know like I need to go buy 150 bips. Like I know what that number is, but I do, again, like it varies and whatever. So I will kind of just double check. Okay. Like that's, again, $1,500. I will come in here. And then the other thing I did do out of the gate. Now, again, some folks, I now just kind of know not that I know them, but I don't rely on them as much, because the quads, you've taught me this too, is like quads are ever changing, right? And what works, there's basically a positive and a negative in terms of like, okay, it's worked X amount of times positively, and so they back test well, and that's kind of why it's here. But this was 100% something that I created. This is one of the first sheets I created, really, right? Was like the 4 quads, and breaking it down. Again, I just used their general allocations to drive that function, right? So again, that's kind of where I have it. And I typically have that sheet up just to like, again, just to have. One of the other things too, is I did use that as a journal out of the gate, right? So I actually tracked my asset allocation and would line item it, or like would copy and paste like the portfolios and have that in there and be like, okay, I've got gold at X dollar amount that equals this percentage of the portfolio. Okay. It's at, call it 5.8%. All right. I have another basically 6% I can buy, let's try to get that to like 12, right? And stuff like that. So, there's definitely, there's definitely components. I had a question the other day about, do I look at each portfolio separately or together? And for the most part, I look at them separately. I'll think of cash a bit more as like a unified front, especially with like my 401k most recently, where I'm kind of limited a bit more to particular like Invesco ETFs, and I can't short in there. So I'll kind of, again, I've got basically about 72% cash right now across my portfolios. But in quad 2, I would probably keep that like that 401k would kind of have my core cash available type thing, right? And but that can get tricky though, because if I'm trying to make a trade in my other accounts, I'm having to sell something down, right? Or like I'm having to make a pivot that I might not want to make. And so I do, for the most part, kind of look across or kind of keep things again across my accounts. Now, I might not have the same positions in all my accounts, right? Like I might have Thailand in one because I didn't, either I wasn't fast enough or I don't know why, but like basically sometimes I just don't have the same positions across the board. But I definitely look at the position sizing for each account, right? So like it varies, right? Like again, if like the taxable account's 100 grand, again, these are not my numbers, but if my taxable account's 100 grand, retirement's $1 million, whatever, right? Like I would have that as like basically variations for each one, and sizing would be appropriate, right? Like I don't, like for instance, I can short in my taxable account, like in my long short account. I don't consider my entire book and then like be like, okay, that 50 basis point or that 1% short is X dollar amount. I look at it at like that again. And my example would be like 100 grand. It wouldn't be at 1.1 million, right? It would just be that 100 grand because that's a fast way to blow up your fucking account.
Yeah. So this is where it all starts to get, it's already complicated, but now it's like,
oh yeah. I mean, it's very personal, right? I mean, like even again, I would encourage you to make your watch list, but you got to make them for what works for you and what's your process.
Yeah. And like going to that just using the numbers can free you from listening and spending time reading whatever the Wall Street Journal, and you can go and read books or whatever you want. At the same time, if you build a watch list that's full of loads of stuff that you don't want to pay attention to, then you won't pay attention to it, and then you'll probably miss something that, if it's full of 100 things and there's 5 that are really important, then you're not going to see the 5 either.
Well, that's the thing, right? I mean, that's where and that's kind of one of the reasons why I built out the different ones, right? Because it's like, okay, I want to see, like I update the ETF Pro, it's like, I want to see what is, especially even RTAs, right? I want to see where is Keith, like what is Keith doing right now? Like what is still in that RTA? Because that means if he's got it on, it's still a position that he's either adding to incrementally or like there's a reason why it's still there, right? Like, people are like disregarding Playboy. But I think that's the wrong way to think about it. Like he's got Playboy in there because he's teaching us a lesson, 1, but 2, he basically believes in his analyst, Brian. And again, there's going to be a point where that's going to pivot in terms of like the signal, and you're going to want to get long that again, right? So it's like, he might not have touched it to this point. He probably has like a minimum size position on, like, again, like in his book or in the hypothetical like RTA book. But there's always something that you can basically learn or discern from the actions that are being taken, in my humble opinion. You don't always have to follow them, but you can help them guide you to creating a portfolio that will hopefully outperform not only the market, but your peers, and preserving compound your returns, which is at the end of the day, all of that like matters to me.
It's funny, so I use that. So the stuff that goes in my notebook, right, is, so the sheets that I share, probably only about, on average, maybe 50 or 60, well, yeah, so let's say 50 views a day, right? So 50 people look at it on average each day. So what goes in my notebook will be something like, why haven't I, so for everything to get updated, I just need to open the sheet once, let it auto update, and then it posts, and then it posts up automatically as soon as I close the sheet. So for me, the stuff that we're going, like, why haven't I updated or checked like the global sheet for 3 days? Like, why haven't I done it? And there's not a lot of people that look at it, but normally someone will send something to say, like, normally the US one, like, oh, the US one looks all a bit wonky, like you haven't updated it for for a couple of days or something like that. So that's the stuff that goes in mine. And that's what I used to use like the macro show for, in almost in a way, like having the queue in like voted questions and stuff like that. I used to, at the beginning, I used to think, oh, my questions are really important. Like my questions are really, really well thought out, but no one ever upvotes them, right? So I got over myself on that. But then I started using it. It's like, why are all these questions going to the top?
Right.
And it normally means, so like today, like, because it's in my head today, because I wrote it down, like, why didn't I update the global spreadsheet since Sunday?
Yeah,
And it means that it's at the back of my head. It's like,
right.
Why is it at the back of my head right now? I mean, it's probably because they're going down because the dollar's going up. But why is it like, why is it at the back of my head?
Yeah. Yeah. And it's funny too, because like, again, like we talk all the time. So I know what you're looking at investing, and like the global equities is not something that you're caring about right now. Right. So it's just like, to me, I know exactly why you're not looking, why you didn't open it up, like as your friend and your buddy. Like, I know exactly why. But yes, it's one of these things where I mean, like that probably was part of your process at one point, was like going in and updating every single one and looking at it in each different thing. But now it's just like, okay, well, I don't need to have that clutter in terms of influencing anything else. I want to go focus on these three components, and how is that going to impact like my asset allocation, or like where I'm going to get big, right? So I'm actually really giddy about this TLT move, to be honest. I keep thinking about it.
So that means you probably shouldn't buy it today.
Yeah, probably. But yeah, no, it's so true, man. I mean, I think yeah. But books.
I think it'll be interesting. You've got a psychologist guy coming up soon, haven't you?
I do.
Next week?
Next week. Yeah, the week today. So I'll we're going to be doing that on Twitter Spaces. So that'll be my our second monthly market meetup.
I have to laugh every time you say it.
I know.
You need triple.
I know. I gotta change it up. It's such a tongue twister. I gotta literally have to think about it. So I gotta change it up somehow. But monthly meetup, maybe monthly meetup, monthly. I don't know. I gotta figure it out. So we'll brainstorm. If anybody's got good ideas for monthly something. But long story, yes, Dr. Andrew Menaker. He's a world-renowned, basically, psychologist. He's helped a number of like big time, hedge funds and other type, CEOs in terms of like psychology and trading and stuff like that, certainly on the trading side. So we're going to be focused a bit more on the marketing. It should be a really fun conversation. And then, we'll also, again, you're not going to see this tomorrow, but the weekly notebook review got pushed tonight. So that'll be tonight. So that's always fun. But I really, again, we've been chatting. I mean, you and I could chat forever, but I wanted to kind of finish on the books because I think that is another good one. You are more well-read than I am. And so I'm actually going to kind of throw it to you in terms of what helped you, if you remember, or what would you say today are some of your core, like, I guess, concepts or like core books that you've read that have helped you improve your process, or so we get to understand. Let's go with understand the process better, right? So like improving is a whole nother thing in terms of like basically probably, but did you read anything once you discovered
the best one's Hedgeye? The best one's probably the Misbehavior Markets.
Sure.
Because
that's the most common one cited.
Because
in full disclosure, I've not read it yet.
Because in reading that, it just shows you why Keith is saying what he's saying.
Got it. I've not read it yet. I should.
I mean, like, it's easy. It's an easy read. There's math in it, but it's not like a math book.
Okay.
But there's just lots of stuff. There's just, I guess it's just a way of thinking. It's just another way to think about things. Like I use that book all the time when some of my friends are big on like climate change and stuff. Mm-hmm. So one of the stories that's in there is about, an English guy goes to Egypt as, I don't think he was actually a civil engineer, but he got roped into it of how to dam the Nile to stop the floods. And one of the big things that he come up with is like, people cite, it's the biggest flood in 100 years. And part of it is he said, well, no, like the worst thing isn't the biggest flood ever. Like, so for sizing a dam, like the worst thing could be actually having a flood that's 90% of the max, but 2 years in a row. Like, that's not what people like. And that's how I think. So I've used this as an example when my friends talk about global warming. And I'm like, okay, so you're saying that in the space of 100 years, the global temperature is going to move up 1%. And it's like, I guess from a kind of a psychological, like everyone's focus is on global warming. What could actually be the biggest devastation could be like 2 or 3 years of really cold weather, because no one's prepared for that.
Mm-hmm.
If you want to get funding for research on crop development, on corn development, or anything like that, you need to have something in there that's got global warming. So your direction of travel is going to be for warmer weather. I need to have a seed that will be able to thrive in
like less
higher heat. But actually the biggest shock to the global food production
supply
could be 2 or 3 years of really cold weather, because no one's prepared for that.
Right. Yeah, everyone's prepared for like drought. Everyone's prepared for like drought and heat.
Yeah. So that's part of the thing. So he's talking about obviously flood and water levels in the Nile, and it's like, but I guess in a way it is kind of a trend following thing. He's like, you want me to build all these dams, but this is what the Nile does. I can't stop the Nile doing the Nile's things.
Yeah.
I need to work with the river to try and get the best outcome that I can.
I love that.
I can't just stop it doing.
Yeah, doing its normal course of action.
I can't stop the river, because if I stop it, and that's the thing, like if I stop the river, if I build the biggest dam that there's ever been, millions of people are going to die, because all the food grows and all the cotton grows in the silt that the river leaves behind.
Yeah.
If you want me to dam the river, I can do it. Right.
But I don't. Correct. I love
what's
that.
Going to happen? So what's going to happen afterwards?
I love that.
But just in reading it, you understand everything that Keith's saying. Not everything, right. But you can understand what it's from, like where it's coming from. That's fascinating. All right. And everything.
I'll get it from the library.
There you go.
No, go ahead. Everything's what?
So, in terms of fractals, like everything's self-replicating.
Got it.
So it's not perfect, because then you get into a bit like what we talked about earlier. It's like how many people trade a 10-minute view on a chart versus how many people trade
like the weeklies or whatever.
But the patterns that charts make, this is getting really wonky, but I mean, like the patterns are self-replicating. It all looks the same no matter what time view you're looking at. If you're looking at trading view, that's the self-replicating part. That's the fractal part.
Interesting. Yeah, no, that makes sense. Makes sense. I love it.
I'm just trying to think.
All right.
I'm trying to
is there anything else out of curiosity? Or again, that's a great one to start. And maybe, as I said, I'll get it from the library, and then, you can be my basically my book club, right? You'd be like, all right, Robert, go read this book, and then hey, dummy, go read this book, and then
I like, what's the other one? Being an engineer. Well, there's another one. So there's Scale by Jeffrey West.
Excuse me. You've shared some of your stack, and that was one of them that was on there. That one looked kind of intense, but I know it's one that you love.
Because it takes all the wonky stuff. Like one of the first so perfect example is, why is there a Z-score on the CFTC futures, right? It's to do with scale. It's like today, so a video that I done before, and I think we talked about it before, was about gamma exposure. Okay. If you look at the numbers that go into it, you can't directly compare the gamma exposure today to what it was in 2008. Because one of the numbers that goes into calculating gamma exposure is the value of the S&P 500. It's how big the contract size is. When 2008,
like basically on a relative basis, right? So like if it's
so the S&P 500 in 2008 was whatever, 1,000, and now it's at 4,000.
Yeah.
So you can't directly compare the two. If you just looked at it nominally on a chart, you'll be like, oh, well, everything's great because all the numbers are bigger.
Yep.
It's just a direct function of the S&P being bigger.
Yep.
So you have to bring it down a level and compare it against itself and put it on a Z-score.
Got it.
So that's what so in Jeffrey West in Scale.
So that's like the scale. Got it.
So he starts talking about like, why are things the size that they are? Like, why does an elephant have, so an elephant and a mouse has roughly the same total number of heartbeats in its lifetime. And that goes on a scale going all the way from mice through humans to elephants to the blue whale, right?
Okay.
It's just that an elephant will live for 80 years and its heartbeat is only 30 beats per minute. Okay. Whereas a mouse will live for 4 years and its heartbeat is like 150 beats per minute.
Fascinating.
Okay. And there's that. So then there's like why does a city, so then you get into like network effects about cities and like, why does a city generate more GDP than a town? And it's like, because
I was gonna say I don't have the answers.
So there's more people there. They're all closer together. It's easy to disseminate information within it. So
sure, that makes sense.
More, like intellectual property will be generated there because you're sharing between things, and you can get easier access to whether it's data or a certain engineer or whatever. It's all closer together. But in that, it starts talking about, so like when Keith says, why is something down? Well, because it's gone up a lot. And that's kind of the thing. Like everything has a scale. So if something's gone up 100%, it's like, how likely is it to do it again? Because in a rate of change terms, if it's not going up 100%, then the rate of change is slowing.
Yeah. 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 It makes perfect sense. Because that's why I think maybe you and I talked about this yesterday. I forget, but basically, yeah, I mean, like, inflation, again, it's like rate of change, right? So it's like the number is still big, but it's smaller. So that was not a hard concept, but that's something that I think can be challenging to really like think, because it's like, well, yeah, but like inflation's still at like 6% or 6.5%, whatever the number is, right? So it's like, but yes,
as an expectation.
But like in terms of the rock, and like, again, it goes back to like one of the things we talked about at the beginning, like the rate of change. I mean, that is the most, if you only really learn one thing from like subscribe to Hedgeye, even if you only do it for like a month, it's like take away like rate of change, because like that will change your life in terms of, again, like to your point, like scale, rate of change, like even if it's like from a big number to still a big number, but like it's gone down 2% or 20%, whatever that is. And then let alone, especially again, like this deep quad four, I mean, we're going from basically the highest GDP, basically the US economy has basically ever seen, right? From like stimulus and whatever, just basically growth effects from basically having everything shut down. And, globally, you two in the UK, to the opposite of that, which is, it's going to, we're going to not only like basically flat GDP, but then from a rate of change standpoint, it's fucking huge.
Yeah. and that's the kind of, I guess, because everyone provides it, everyone asks, we all know, well, at least some people take the piss out of the economists and everything else that come out with these. But just because everyone comes out with, oh, I think GDP is going to 4. Well, like, how often has he been right, or she?
Yeah.
It's that like an actual number doesn't matter.
Right.
It's like, where are you coming from? Where do you think you may be going to?
Mm-hmm.
And how quickly or slowly will it get there?
Yeah. And, I think back to like when I started in like the business, right? It was like 2006. So in China was just ripping, right? I mean, like, you know, mid 2000, China was ripping, and their GDP growth just kept creeping higher, right? But then there came a point in like 2007. Again, I don't know the numbers off the top of my head, but basically call it 2007, I think it was, where it started going from like 9%. Again, still huge numbers, but it was like started slowing to like 8.5 or like 8 or what. Again, I'm just making up the numbers right now, but it went from like very big numbers to still very big numbers. And at the time, I like looking back now and knowing what I do 2 years later from Hedgeye, I can see, yeah, well, no shit, like the commodities super cycle fucking ballooned then because, you know, everybody was like basically folks were chasing and then like reaccelerating kind of demand, but that takes like 2 years. So like all projects that started in 2006, right? You know, and J. Vance Galver talked about this on, I think, the call the other morning, is like, you know, there's a huge conundrum in terms of like, okay, if demand is there, but the supply isn't, a mine can't just get turned on overnight, right? And so there are not only capex that's involved, but then planning, and then you got to look at like resources, like the resource itself, and then you got to look at, okay, backfilling that resource, right? So they had planned on this mine having a life of say 20 years, right? Well, now if we're going to increase basically production, that span of the life shrinks, right? So it goes from say 20 years to 15 years. Well, now they have to backfill, you know, and try to go drill and explore in other areas of their property and or other locations, but that's not always going to be successful, blah, blah, blah. So like, there's just so many other components that basically factor into the one decision of saying, okay, I'm going to increase supply in order to meet the demand at these higher prices. Well, 2 years later, the supply is there, GDP is cresting and the rate of change is falling for like the core economy that was demanding it. And now you've got now you've got prices high, supply coming online. And again, like all these things at the time, you know, it was like, oh, like whatever, China's still at an 8%, you know, growth or 7% growth or 6, whatever the fucking numbers were. Right. And it's just like, wow, that's still very high. And like the demand's still there, blah, blah. But looking back, you can see all of the data points. And I bet if Hedgeye was around, it would have been incredible to look at that. Like, you know, and we're kind of going through it in a different set right now, but like in terms of like rate of change and extremes and stuff like that. But that's something that I definitely have thought about over the last few months as we've gone from like one extreme to the other, is like looking back in time and being like, okay, like especially with the commodity super cycle, right? Like, you know, that was the last time we really had one. And you can look back at the numbers and be like, wow, the rate of change was there. Like the clues were there. It's like, and but not
if
many
you were just
saw
listening,
it.
but if you were just listening to the stories,
correct. Oh, I love the stories, baby. I loved them. Yeah.
But that's but this. Okay, so for me, what does Hedgeye give me? So I do all the numbers anyway, myself. They give me this big, huge, like deluge of information, which I pick what I need from it. But if I want to, so I do read quite a lot of technical books, but if I want to read something about being a reformed gold bug, right? If I want to read something about 1971 and like feed the narrative part of my brain, I can, knowing that it's just a story.
Yeah.
If I want to read or watch something telling me about these amazing, like, this is the next crypto coin that's going to change everything, I can do it, and I can read it or listen or speak to whoever. But if without saying, like, without being like, but if the number's not going up, then it doesn't matter.
It doesn't matter. Right. Exactly.
I can still have it in the back of my head, you know, like all the time I'll listen to a podcast and I'll be like, right, oh, that's great, but that's a quad 2 story.
Right.
This is just like in my head, I'm just thinking, right, this is like 6 to 9 months too early.
Yeah. Right. So isn't that fascinating how like we've shifted, right? We just shifted being like, oh yeah, that's great. And that's like really interesting to know. But there's no actionable detail, or there's
Yeah.
nothing actionable off of that knowledge right now.
But then
Yeah,
like it's so in my head, like that's what I'm saying. So now because I build all these things that show me all the numbers, this
yeah,
is the stuff that goes in my notebook. So if I listen to something and I think, right, well, that's great. Yeah, okay, it's really interesting, but that's a quad 2 thing. That's like 9 months down the road.
yeah,
That'll go in my notebook and it will go on somewhere and it'll set a reminder, because what I actually want is for when that quad 2 comes around, I want nobody to be talking about it.
right, right.
Because they've been like completely just taken to the woodshed for the last 6 months.
Completely. No, I think it's really smart. And you know, we've talked about this, or I've talked about this on the notebook review, but in terms of like setting down like long-term ideas in terms of good stories or good stocks with like pod, improvements, but just like bad quad 4. And coach basically reiterated that this morning with McGough. I believe it was McGough on the call this morning, which I did get a chance to listen to. And, he basically just said that. He was like, listen, have a sheet down, or like have a watch list, or whatever it is that you need to do, but write these names down. Like write Amazon down. Amazon's pods are going to improve in May. Well, May is like 3 months from now. So that's a long time. And, or 2.5 months, whatever it is, right? Like 2 months from now, that's a long time from now, right? Especially in this space that we're in.
Yeah.
And there's a number of those, right? So it's like, have some of these names, like whether it's McDonald's or Amazon or whatever, like, just the list goes on, right? So like make those notes, and that's exactly what you're doing, right? That's what's your notebook. I have a portion of my notebook that does that, right? It's like, okay, these are important names that I want to have and I want to get exposure to when the time is right, when that signal, when it starts putting in that lower high, not making lower lows, right? Putting in a higher low is what I was trying to say, and sort of confirming that like that base is in, right? And that,
and being comfortable that you don't have to buy it. Like if it bottoms at 9.99, it doesn't mean you have to be buying it then.
right. Or at 10:05, right? You can wait till
Exactly.
11, or like wait till, wait
Oh yeah, like it gets to 11 and it comes back to 10.50, but it makes a higher low and it's got a good volume profile and everything else. And it's on quad 2 and you add all these things. You don't have to be the hero that buys the bottom and be like,
to your point, you don't have to buy the first dip either. You don't have to buy 10.50. You can have it go down, bounce, right? Go back up to 11, and then it comes down to 10.70. You're like, all right, perfect. This is the confirmation I need. Again, which I'm just using, this is a generalization, but like, then you start your position, right? And then if it goes up, maybe you add again as it goes up to 11, and then it comes back down. It goes back down to 10.65 or whatever, or 10.50 again, and it challenges that level again. You step in, right? And you go, and then you kind of keep making those moves. And then all of a sudden you've got your full asset allocation and you're riding the wave of a new trend. Yeah. I think that's a phenomenal way to end. This has been a great convo as always, Chris. I appreciate your time. Hopefully the folks out there, we took a step back in time to the beginning, and we've kind of brought it to what we're doing today and everything in between. So, cheers to all. We'll be back at it next week. Hopefully, I think we'll probably line up another guest. I think we got a couple in the queue, just timing, anyway, but awesome stuff. Appreciate it.
Thanks, man.
You're the man. All right, bud. We'll talk soon.
Cheers, bud.